today. So it's group consolidation. So this group consolidation question is quite an intense one. It is a very intense question. This is the last question we are doing for group consolidation, and then we go straight away to group cash flows. It's quite an old financial reporting question. You can't even be having it in your past papers. But I mean, this question is the mother of all group consolidation questions. Once we get this right, then we can never, ever go wrong. We can never, ever go wrong. We can never, ever go wrong. So then the keywords, what are the keywords here, ladies and gentlemen? The keywords that we have here, of course, whenever you get this kind of a group consolidation question, it will be very important for you to start reading the requirements. So what do they want me to do here? They want me to give them a consolidated statement of profit or loss and other comprehensive incomes for H group for the year ended 31st October 2022. And then they want me to give them a consolidated statement of financial position for H group as at 31st October 2022. The catchword, what does this examiner want you to do to get a fail? This examiner would want you to take a lot of time doing this question. So many students in this case here will take more than 2 hours to do this question. Whenever the examiner brings us a question of us doing consolidations of the profit and loss, and then consolidations of the statements of financial position given, so many students will take at least 1.5 hours. You should never fall into the trap of doing one question for more than 37 minutes. Because time management is key, ladies and gentlemen. Time management is key here. So then what are we going to do, ladies and gentlemen, here? So then we read the question. Let's read the question. So we're reading the question here. We are told H Limited, a public limited company, by the way, are you able to hear Mwalimu? Are you able to hear Mwalimu? I just have to confirm. If you're able to hear Mwalimu, if you're able to see my board very well, just get into the chat box there and just mention there why for yes, if you're able to hear Mwalimu very well. Thank you very much, Samuel. Thank you very much, Maggie. Great. Thank you very much, David. All right. So we are told here, H Limited, a public limited entity, operates in the information technology sector. It has made several investments in other companies within the industry, which has earned it market leadership in the sector. The following draft financial statements for the year ended 31st October 2022 relate to the H Limited and its investment companies. So you can see this is the date of the financial statements given. So the DOF, the date of the financial statements given is 31st October. So the DOF, the date of the financial statements given is 31st October 2022. Very, very important for me to note this. There are two dates that are really important as pertains what year? As pertains. Hope you may not be able to get that question. It's a very, very old question, very old question, but very good. I've sent the question to you on WhatsApp. So, ladies and gentlemen, you have to consider always these two dates, the date of acquisition and the date of the financial statements, the DOF and the DOA. When did you acquire these subsidiaries and other investments, and when are the financial statements being done? So now we have been given the date of the financial statements. That is really important to me. All right. Then we start reading additional information here. We start reading additional information. What are they telling us here? They're telling us here, additional information one, that H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019, when the retained earnings of S Limited stood at 340 million. Very good. So H Limited did what? It acquired 80% of S. It acquired 80% of S. So in this case here, H acquired 80% of S. So let me ask you a question. 80% is so huge. So who is S to us? 80% is so huge. Who is S to the group? Who is S to H? 80% is a huge shareholding. So who is S to H in the group? Is it an associate? Is it a subsidiary? Is it a joint venture? Who is S to the group? Who is S to the group? Okay, so this is more than what year? This is more than 80%, yes. It's more than 50%, I mean. Whenever you have an investment being more than 50%, it means that S is what year? S is a subsidiary because this is more than 50%. This is more than 50%. So S is a subsidiary. And of course, this H will be a parent company. This will be its parent. Why? Because H is able to control S. So in this case here, they have told us the date of acquisition. They have told us the date of acquisition. They have told us the date when we did this acquisition. They've told us here the date of acquisition. They're telling us it is 1st November 2019. So the date of acquisition is 1st November 2019. So we have here 1st November 2019. And don't forget the date of the financial statements was 31st October 2022. So it means that since we acquired this subsidiary to the date when we are doing our financial statements, some number of years have lapsed. Some number of years have lapsed. How many years? So I have, of course, the year ended 31st October 2020, 2020, 2021, and then the whole of 20 what year? 22. So here we can talk of only number of years. From the date we acquired this subsidiary to the date of the financial statements, we have 3 years here. So number of years, these are 3, and I can explain. So we have here 1st November 2019 all the way to 31st October 2020. That is year number 1. All right. And then we have the second year, this one here, now going all the way to 31st October 2021, another year. All right. And then now we have in this case here the year ending 31st October 2022. So if you count, these are how many years? So we have 1 year, 2 years, 3 years, like that. NOY stands for years, number of years. So number of years, we have 3 years. We have 3 years. We have 3 years. Up to here, are we together, ladies and gentlemen? Can you kindly put your thumbs up like this if you're together? Can you kindly put your thumbs up like this if you're together? Kindly put your thumbs up like this if you're together. Thank you very much. So then we go to, I'm trying to look at the group structure. I'm trying to look at the group structure. I'm trying to look at the group structure. So I don't have to read about this, like what was the retained earnings outstanding on the date of, I don't have to read so much. Look at note 2. Note 2, M Limited is the main competitor of H Limited. And on 1st May 22, M Limited and H Limited each acquired 50% of the 200 million ordinary shares of shillings 10 each in L Limited. So we have here H Limited together with M. Each acquired 50% of a company called L. So you're seeing again a situation where H acquired some 50% interest in L. 50% interest in L. So, ladies and gentlemen, if you remember our summary, we said if shareholding, this is what we said, if shareholding is more than 50%, then this becomes a subsidiary. If shareholding is more than 50%, this becomes a subsidiary. And we went ahead and said, if shareholding is exactly equal to 50%, if you can remember, we gave this one a name. Is there somebody who could be remembering? If shareholding is exactly 50%, we gave it a name. It's a joint venture, yes. It's a joint venture. It's a joint venture. And I did tell you how we normally account for joint ventures. There is a special standard for accounting for joint ventures and associates. Is there somebody who can be remembering this special standard of accounting for joint ventures and associates? I gave you the name of that standard. I gave you the name of that standard, that whenever we have a joint venture, Mr. 50%, Mr. 50%, Mr. 50% is a joint venture. And joint ventures and associates, we normally account for them using IAS 28. using IAS 28, what Mr. Collins is calling equity accounting method. What Mr. Collins is calling equity accounting method. So that's a joint venture. And then we went ahead and said, what if our shareholding falls in between 20%, but simply all the way up to 49.999, slightly short of 50%, slightly short of 50%. This investment here, we called it a special name. This investment here, we call it a special name. The special name that we call this one, it will be what year? It will be an associate. It will be an associate. It will be an associate. If shareholding is 20% all the way to 49.99%, this becomes an associate. And then we have a situation where now our shareholding is less than 20%. We said that this one will simply be a simple investment, or what we called a financial instrument, 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 or what we called a financial instrument. Have you guys taken a summary of this somewhere there as a note? Is there somebody who has taken a summary of what I have here somewhere there as a note? Even if you had written in the other classes, this is very good summary. Is there somebody who has been able to take this shareholding note? More than 50%, we are talking of what here? A subsidiary part of us where we have control, a subsidiary where we have control. And if shareholding is exactly equal to 50%, then we shall account for this investment as a joint venture. And if this shareholding is falling in between 20% all the way to 49.999%, then we call that one an associate. And if shareholding is less than 20%, then that will be a very special investment that we shall be calling a financial instrument, or a simple investment, or simply a simple investment. So H has acquired 50% of L. 50% is Mr. 50%, exactly 50%, then L in the group will be called a joint venture. However, this examiner wanted to cheat my students using this concept of a substance over form. Using this concept of substance over form. Let's continue reading this question. What have they told us, ladies and gentlemen, here? They're telling us here that the consideration paid by H Limited consisted of cash of shillings 15 per share and also 1-for-2 share exchange when the market price of a H Limited share was 20. M Limited also paid 15 per share for their interest, but did not issue any shares to the owners of L Limited. The ordinary shares of L Limited have one voting right each. Upon the acquisition, H Limited had a contractual right to appoint many directors to L. Upon the acquisition, H Limited had a contractual right to appoint 60% of the board of L, with the remaining 40% being appointed by what year? By M Limited. Ladies and gentlemen, this semester, this examiner really messed up with my students big time. Because, I mean, I taught them very well that 50% is a joint venture. And the joint ventures, we don't consolidate them. Joint ventures, we shall always have one line. For example, investment in L, where we take, in this case here, the cost of the original investment. All right, we add any equity increases, any share of post-acquisition PAPs, etc. And then we take just one number to our group consolidated income statement, or to our group consolidated statement of financial, like an investment in joint venture. So you don't consolidate like adding line by line. But you see now here, this guy went ahead to test our students on this concept of substance over form. Formally, we know that if we have exactly 50% of a company, that company is our joint venture. But what is the substance? There is an underlying current passing. There's an underlying current passing where they are telling us that fine, it is exactly 50%, but we are able to control this particular L limited through management. We have what we call management control. We are the ones in this case here who are appointing most of the directors, 60% of the directors, to the board of L. Ladies and gentlemen, listen, this concept of substance has disturbed so many students. Like right now here, we are about 32 students. Assuming all of us are billionaires, and then we contribute 10 billion Kenya shillings, and then we have a great kitty of 320 billion Kenya shillings. 320 billion Kenya shillings. And then we shall call ourselves, in this case here, the RCM billionaires. RCM billionaires, RCM college billionaires. So these RCM college billionaires, we go straight away and acquire 80% of Nairobi Hospital. We buy 80% of the shares of Nairobi Hospital. So ideally, because of our shareholding, we are the ones who are supposed to be controlling Nairobi Hospital. But I mean, you know, you and I are accountants. We don't have, in this case, experience of running really a great hospital of this nature. And then we have another party, in this case here, goes ahead and buys 20% of this Nairobi hospital. This party that has bought 20% is a group of doctors, a group of doctors has bought what here? 20% of Nairobi hospital, but we have 80%. Contractually, through a memorandum of understanding in an annual general meeting, we tell these doctors, hey, we are accountants, leave us to go out there and do returns for people and do accounting financial reports for people. You guys, we're giving you the mandate of running Nairobi Hospital because, I mean, this is your work. This is your work. You sit there and manage. So assuming Nairobi Hospital has got, say, like 10 directors who sit to manage Nairobi Hospital. So we tell these doctors, fine, us will only be left with, say, 3 directors in the board. So the other 7 directors will be taken by yourselves. The other 7 directors who are sitting, in this case here, in this Nairobi Hospital, will be taken by yourselves. So, ladies and gentlemen, once we give these doctors, let's call them Doctors Limited, we have given Doctors Limited a contractual right of running this hospital. They're the ones who are appointing majority of the directors. Directors are the ones that run really an organization. So then who do you think is in control really here? Who do you think is in control? Is it the RCM billionaires ourselves here or the Doctors Limited? Who do you think is in control of the hospital? Who do you think is in control of the hospital? Who do you think is in control of the hospital? Is it RCM billionaires given our shares, or is it, in this case, the Doctors Limited? Yeah, it is the Doctors Limited. It is called a substance over form. It's called a substance over form. Please don't let me down in this exam that is forthcoming. These people may want to steal your great show by testing you on this concept of what here, controlling a company through substance, not shareholding. Remember, fine, we should have been the ones controlling because we have the highest number of shares. We should be the ones, in this case here, appointing most directors, but we have ceded our right. Contractually, we have given our right here to someone else to manage the company on our behalf. Now, ladies and gentlemen, please listen. This would straight away mean that the Doctors Limited is the one that is in control, and therefore they are the ones. The one who is in control is the one who will consolidate. Now, here, L automatically becomes a subsidiary. So L becomes a subsidiary by virtue of management control, by virtue of management control. So even if we own exactly 50%, but by the fact that we are controlling the management, automatically, then AL becomes our subsidiary by virtue of management control. I don't know, ladies and gentlemen, whether we are communicating. Are we really together? This is so important for you guys. As somebody who has ever examined this FR, I know those bolts, if an examiner touches them, you will be able to disturb so many students. I don't know whether we are together really. Are you able to give me feedback there? Are we able to understand that for sure this L is a subsidiary, the 50% notwithstanding? Are we able to understand that? Yeah, great. Thank you so much. Great. If you forget this, you get 0 in the entire question. You shall get 0 in the entire question, and nobody shall salvage you. Even if you tell us you are sick during that, nobody will salvage you. Nobody will salvage you. Nobody will salvage you. It is about substance over form. And that is why, if you look at IFRS 10, International Financial Reporting Standards number 10, all right. How does it define control? How does it define control? It defines control using the concept of substance over form. Substance over form. It's not about the number of shares you own. You could be having tiny shares, but substantially you are controlling the company. It is substance over form. They normally use the acronym pair principle, the pair principle. And these you have to write this. This is how they define control. It is substance over form, and they normally use what we call the pair principle, that somebody who is in control should be powerful. You must be having the power. You must be having power that you're wielding within the company. You must be having power that you're wielding within the company. All right. So we must be exposed. So exposure to variable returns. To variable returns. Exposure to variable returns. Basically, this is our what here? Our profits of the company. You must be having some exposure to variable returns, meaning that you must be having some shareholding. You must be having some ordinary shares, even if it's 5%, even if it's 10% or 80%, you must be a shareholder. If you're not a shareholder, then you're not exposed to the variable return. You're not exposed to the profits. You won't be able to get any dividend. So you must be powerful within the organization, and you must be having some exposure, even if it's 2%. You can't tell me that you have exposure to dividends when you have exactly 0. If it is 0, then we can't say that you have got any control. But if it is anything more than 1, talk of anything more than 0, even if it's 0.9, at least you have some dividends you're going to be getting. And then number 3 is the ability to use the above power, ability to use the power, to use the power, to use the power to increase the above returns, to increase the returns, to increase. If you look at your past papers, you'll see this question being asked. How do you define control? It's called the pair principle. You must be powerful, you must be exposed to some dividends, and then you must be able to use your power. You use your power here to increase profits for the, there are people, very rich people, they'll simply come and buy. They've bought, say, like 80% of RCM online college, but they're not bothered. They don't even want to come for board meetings. So in that case, then your power is not really helping the company, because you must be able to come to board meetings. You must be able to do what we call cost control. You must really be seen to be in control for you to say that this is your subsidiary, for you to come and say this is your subsidiary. So this is a very, very important concept as per IFRS. We call it IFRS 10. IFRS 10. IFRS 10. We have got various IFRSs that really govern group consolidation. Group consolidation. So then L, regardless of the 50%, L is our subsidiary because of what here? Because of management control. We are able to send most directors 60%. We are able to send most directors. So then come here and give me the date of acquisition. When did we acquire this subsidiary called L? When did we acquire this subsidiary called L? So, ladies and gentlemen, when we acquired this subsidiary called L, we are told here, M Limited is the main competitor of H Limited, and on 1st May 2022, M Limited and L Limited each acquired 50% of the ordinary shares of L Limited. So the date of acquisition is 1st May 2022. 1st May, 1st May 2022. And then the date of the financial statements is 31st October 2022. This is a middle year acquisition. So let's count the number of months. Here we can only talk of number of months. We can only talk of number of months. So number of months, ladies and gentlemen, what do we have here? We have the whole of May, because it began from 1st. So May, June, July, August, September, and then the whole of October. The whole of October. Those are how many months, ladies and gentlemen? Somebody was assisted me to count. How many months are we talking about here from 1st of May 2022 to 31st October 2022? 6 months. These are 6 months. So norm stands for what year? Number of months. So norm stands for number of months. Norm stands for number of months. Norm stands for number of what year? Number of months. Norm stands for number of months. So then I've got 2 subsidiaries. I have 2 subsidiaries. Now with these 2 subsidiaries, what do I do with them? So if I'm the one doing this kind of a question, ladies and gentlemen, I would want to understand the valuation. I would want to understand the valuation of these particular assets, of these particular subsidiaries. So how do I do valuation of subsidiaries? I use the equity approach. So I'll be able to get the net assets of the subsidiaries. I'll be able to look for the net assets of the subsidiaries. So mentioned there. So the next step will be for me to come here and get net assets of the subsidiaries. So I'll be able to come here and get the net assets of subsidiaries. And we shall start with subsidiary S. The first one is subsidiary S. Subsidiary S. So remember, net assets are normally captured using equity. And we're going to get these net assets at acquisition and at reporting. At acquisition and at reporting. Those two. Because I would want to see the changes in the net assets. There is no way I'll ever talk about group consolidation without understanding the net assets. So are you guys able to give me the examples of equity components that I'm going to bring here? Is there anybody who is able to remember examples of the equity components that I will be bringing here? Somebody talk to me this evening. Equity component that must always be there whenever I'm doing subsidiary valuation. Equity components. Are you able to see, ladies and gentlemen, the equity components? Is there somebody who is able to remind us the equity components, like share capital, ordinary shares? I love that. Any other? Those are the equity components. Yes, equity components. So in this case here, we have ordinary share capital. So we have here ordinary share capital. So could you then kindly go to the subsidiary S? No, preference shares don't bring preference here. Go to, thank you, Deweson, but don't bring preference here. Now, Deweson, if you come and look at these equities here, these are the equities here. So ordinary share capital for S Limited. Ordinary share capital for S Limited, this is this one is S Limited. So I want ordinary share capital for S Limited. So for S Limited, I can see the ordinary share capital 1500. So then I will say here, ordinary share capital doesn't keep on changing. So at acquisition is 1500 and at reporting is 1500. Ordinary share capital. At acquisition, 1500. Please don't take, I've always seen students taking here 1500 to, no, this is for a different company. It's S I'm looking for at the moment. Then we have share premium. I can see for S it's 500. So you come and write share premium. So we have here share premium. So the share premium, we have 500. This again doesn't change. This doesn't change at all. The one that you have to be very careful about is the retained earnings. Right there, retained earnings. So you must be very careful about retained earnings. Because retained earnings, the example will give you retained earnings at acquisition. The examiner will give you retained earnings at acquisition. The examiner will always give you retained earnings at acquisition, and then we have retained earnings at reporting. If you come here, you'll always be given this. You can see here, H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019 when the retained earnings of S Limited stood at 340. Stood at 340. Stood at 340. So these are retained earnings on the date of acquisition. So on the date of acquisition, retained earnings at acquisition is 340. And then now we have retained earnings of S on the report, on the statement of financial position report. Retained earnings on reporting, at reporting, as the examiner given me this retained earnings at reporting. So retained earnings at reporting, ladies and gentlemen, retained earnings at reporting, ladies and gentlemen, yes, we are told here, retained earnings for S at reporting is 20 what year? Is 2070. Is 2070. Retained earnings at reporting is 2070. So retained earnings at reporting here is 2070, like that. 2070. And then I'll remember the other net asset. The next net asset here will be fair value adjustment. You call it fair value adjustment. Fair value adjustment. And then, of course, we shall have what we call depreciation of fair value adjustment. Very, very important. So we have fair value adjustment, and then we have depreciation of fair value adjustment. Is there any other equity component you think I need to come and bring here? Anybody talk to me? Do you think in this case here we have any other equity component that will be very, very important for us to come and put here? Can you get this right? I give you a present. I give you 300 bob. Any other equity component that you think will be very, very important for us to put it here? Thank you very much, Collins. Thank you very much, Collins. Thank you very much, Collins. In this case here, we have what we call URP or UPS. UPS. I like calling it UPS up. UPS upward stream. Upward transaction or upstream. Call it upstream. Upstream. Upstream transaction. Upstream transaction. I shall bring it here. And I would want to explain what this upstream transaction means. I would want to explain what this upstream transaction means. Students, you see the parent company is H. The parent company is H, and then we are working on subsidiary S. When the parent sells to the subsidiary, this one will never come here because that is downstream. Downstream is very good. That will never come here. But when we have subsidiary selling H, subsidiary selling goods to H, that's upstream. Subsidiaries are earned fake profits, especially if those goods are still with H, they're still within the group. So whenever S sells to, so in this case here, whenever you hear of upstream, it's about subsidiary selling to parent. Selling to parent. Subsidiary selling to parent is what we call what here? Upstream. And if it's upstream, then you must come and deduct this UPS. For the students who are attending this class for the very first time, UPS or URP, one and the same. UPS stands for upstream, no, not upstream, but unrealized profits. Unrealized profits on stock. Unrealized profits on stock. So this stands for unrealized profits on stock. Unrealized profits on stock. So Collins, are you able to send me your mobile number here? I give you your gift. I must give you a gift. I always give gifts. I appreciate that's, I mean, getting a student who is students who are able to follow very well. Not many are able to really follow. So Collins, I'm waiting for your number. Everybody will be getting a present. Today is a day for getting presents. Collins, today is a great day for getting presents here. Today is a great day for getting presents here. So if you strive to understand these things deeply, very well, then you will end up getting a lot of presents from me. Just be keen enough. Be keen enough. All right. Thank you so much. So this is unrealized profits on what we call stock. On what we call stock. And how do we calculate this unrealized profit on stock? How do we get this unrealized profit on stock? Ladies and gentlemen, to get unrealized profit on stock, UPS, very, very important. How do we get this UPS? To get unrealized profit on stock, normally what we do, we take the profit margin. We take the profit margin times remaining intra sales, times remaining intra sales or internal sales. Anytime they want us to get unrealized profits on stock, we take the profit margin times remaining intra sales. So as the examiner given me anything to do with the S and H working together, let's see in the question. 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 So in this question, yes, they have told us from note number 4, note number 4, for your revision, you write there UPS, note number 4. They have told us during the year ended 31st October 2022, S Limited sold goods worth 400 million to H Limited. You can see the subsidiary S selling goods to H. So that's what we call an upstream transaction. Upstream transaction that must affect my net assets of the subsidiary. That's upstream. All right. So you're told here, S Limited reports a gross profit margin of 25% on all of its sales. So they've given me gross profit margin is 25%. Gross profit margin is 25%. So gross profit margin is 25% times, let's see. You see, all the goods that were sold within the group were worth 400. I'm cutting the millions, were worth 400. All the goods sold within the group were worth 400. Ladies and gentlemen, please listen. Come here. S Limited sold goods worth 400 million to H Limited. S Limited reported a gross profit margin of 25% on all its sales. 20% of these goods remained in closing inventory. 20% left, 20% were remaining. Remember, this is profit margin times risk. Risk is remaining intra sales. So out of these 400 goods that were sold by S to H, we still had 20% left. So can you kindly give me these remaining intra sales times profit margin? Is there somebody who is able to give me this unrealized profits within the group? Anybody who is able to give me these unrealized profits within the group? Unrealized profits within the group? Is there anybody who is able to give me the unrealized profits within the group? Anybody who is able to give me the unrealized profits within the group? 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 Yeah, somebody is giving me a figure of what here? A figure of 20 million. So we shall not write million, we shall just write 20. So remember this UPS does not arise on acquisition here. No. We did business after acquisition. So this UPS can only be subtracted here. Remember, we are subtracting it because it's fake profit. You're claiming to make profits from a sister company. All right. If those goods are being sold to third parties outside there, no problem. But they're still within the group. And the IAS 2, International Accounting Standard number 2, says that we can never have profits within stocks. Never. So that profit has to be deducted. That profit has to be deducted. So I hope you guys were able to write here fair value adjustment, and then we have depreciation or fair value. The same case here, this depreciation or fair value adjustment, we can never book anything there because depreciation occurs over time. At acquisition, things are brand new. No depreciation should be charged there. We shall only charge this depreciation here. here. Now, ladies and gentlemen, please listen and listen to me very well. I'm so happy because you're following. There are so many gifts coming your way. There are so many gifts coming your way. So we are told something very, very interesting here. We are told something very, very interesting here. We are told something very, very interesting here. We are told here, H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019 when the retained earnings of S Limited stood at 340. The acquisition consideration comprised cash of 1830 million. The fair value of the identifiable net assets of S Limited at acquisition were like this. The fair value of the identifiable net assets of S at the date of acquisition were worth 2440. The net assets, if you come and add this at the date of acquisition, the net assets at acquisition were worth 2440. The total net assets at acquisition were worth 2440 at acquisition. Then, of course, they want us to use the balancing method to get the fair value adjustment. What have they told us about this fair value adjustment? What they have told us about fair value adjustment, ladies and gentlemen, they have told us here the fair values of the identifiable net assets of S Limited at acquisition date were 2440. The excess of the fair values over their carrying value was due to unrecognized brand whose remaining economic useful life at the date of acquisition was 5 years. So in this case here, they are telling us that the balancing figure will be a brand thing. Allow me to use fair value adjustment like this. Fair value adjustment. But the balancing figure here will be, in this case here, a brand value. So this will be a balancing figure. So is there somebody who can give me 2440 minus 340 minus 500 minus 15? Fortunately, I know these are zeros. The two are zeros. So 2440 minus 340 minus 500 minus 1500. Can somebody give me this fair value adjustment, which is attributable to an unrecognized brand? Unrecognized brand. So Naitale is giving me, and they're giving me 100. So what do you know about this fair value adjustment? What figure do you think am I going to write here for fair value adjustment at reporting? Fair value adjustment at reporting. What figure? Remember, fair value adjustment at acquisition will be exactly the same as fair value adjustment at reporting. So I'm going to book the same 100. I'm going to book the same 100. I'm going to book the same 100. So then the only thing that I need, ladies and gentlemen, to do is to come here and ascertain the depreciation or impairment in this case, because this is a brand name, it's an intangible asset, impairment. How do I get this? I will take 100, I divide this by the number of useful years. And they have told me that the remaining useful years were 5. So this one here gives me 20 per year. 20 per year. But remember, since we bought S Limited, how many years have lapsed since we bought S Limited? How many years have lapsed since we bought S Limited? How many years have lapsed? Go back to your group structure. Go back to your group structure. Go back to your group structure, because I want to get the total value lost from this brand value over time. Is there somebody who is able to go back to the group structure and tell us, Mwalimu, since you bought S, this number of years have lapsed? Because I'm interested in getting the cumulative. Is there somebody who is able to remind us that we had 3 years that have lapsed? 3 years for the students who started with me, the class. Since we bought S to date of the financial reports, we have 3 years, and each year we are losing 20. So the total impairment will be 20 times 3, which gives me 60. The total impairment will be 20 times 3, which gives me 60. It seems guys have forgotten about these 3 years. It seems guys have forgotten about these 3 years, and I don't mind reminding them. I always like repeating things. So in this case here, the total depreciation or the total impairment is 60. And of course, this has to be deductible. So then are you able to give me the net assets of this subsidiary S at reporting? You take 1500 plus 500 plus 2070 plus 100 minus 60, because depreciation has to be subtracted. Minus 60 and then minus 20, and then I'll be able to answer. Ruben, thank you very much for saying no. I like students who are open. Remember, students call me the chief CPA ninja. Yeah, I like being asked questions. I like seeing students here contributing. But first of all, give me the net assets of the subsidiary at reporting. At reporting, is there somebody who can give me this figure? 4090. Now, Italy, I don't know how you added. I don't know how you added. So remember, it's 1500 plus 500 plus 2070 plus 100 minus 60 minus 20. It should be 4090. It should be 4090. So before I answer Ruben, is there somebody who is able to see that our net assets have grown? Yeah, our net assets have grown. What is that special name that we give to our growth of net assets? We normally call growth of net assets, we normally call it the post-acquisition. The post-acquisition profit. We normally abbreviate this as PAP. So our PAP will be 4090 minus 2440. 4090 minus 2440. Our PAP from this subsidiary, our PAP from this subsidiary, before I answer Ruben, it will be 4090 minus 2440. You can see it was 2440 at acquisition at the beginning, and now at the end it's 4090. So when you subtract, what are we getting, ladies and gentlemen? Here we are getting Sarah, we are getting 1650. Thank you so much. So please give us the share of NCI. Is there anybody who is able to tell me? NCI, of course, is non-controlling interest. NCI is non-controlling interest. Do you know the percentage of non-controlling interest? Is there anybody who knows the percentage of non-controlling interest? Yes, because we the controlling, we have 80%. We the controlling, we acquired 80%. We the controlling acquired 80%. So the non-controlling must be taking the other percentage. The minority shareholder here will be having 20%. Will be having 20%. So in this case here, the share of a non-controlling interest, it will be 20% of the 1650. So these guys here, we shall give them how much? 20% of the 1650. These guys here, we shall be giving them how much? We shall be giving them 20. Thank you so much. No, 20, you're saying this 20%, 20%, yes. So times 1650, so shall be giving them 330. I tell you, thank you very much, 330. So the students who are consistently giving me answers, very soon I'll call for your mobile phone numbers and then I give you a present. I'll be calling out for your phone numbers and then I give you a present. Now I come back to you, Ruben. Ruben, I come back to you. See Ruben here. What happened, Ruben, here is that we got a subsidiary called S on 1st November 2019. H Limited acquired 80% ownership shareholding in S on 1st November 2019. So we had drawn this group structure and said, H Limited here acquired 80% of S Limited, and the date of acquisition is 1st November 2019. But the date of the financial statements, Ruben, is this one. The financial statements given there, they're going up to 31st/10/2022. 31st/10/2022. All right. So, Bwana Ruben, if you count here, the date of the financial statements will be found here. The date of the financial statements will be found here. The date of the financial statements will be found here. The date of the financial statements, you can see here, 31st October 2022. They are normally dated. So then if you count very well, Bwana Ruben, you'll be able to see that we stayed with this subsidiary. The first year will be 1st of November 2019, all the way to 31st/10/2020. The other year will be, of course, the following year will be 1st November 2020, right? To what year? 31st October 2021. And then now we have here 1st of November 2021, all the way to 31st October 2022. So these are how many years? We stayed with this subsidiary for 3 years. We stayed with this subsidiary for 3 years to the date of the financial statements. And if there is an impairment of 20 per year, then over the 3 years, so here you charge 20, 20, 20. That is 60. So Ruben, I hope now we are together there. Thank you so much. I can see your response there. Thank you so much. All right. Now then, ladies and gentlemen, what I will do, remember I've got two subsidiaries. We have another subsidiary called L. Whenever I've got subsidiaries, I have to account for net assets of all the subsidiaries that I have. So then you come and get here the net assets of subsidiary L. Come and give us net assets of subsidiary L. So here there are so many gifts to be given. So many gifts to be given. Here there is a big gift of 500 bob. Subsidiary L. Net assets. Net assets. Net assets of L. All right. So we have here net assets at acquisition. We have net assets at what year? At reporting. 500 bob. 500 bob. So we start with share capital as usual for L now. For L now. So we start with share capital as usual. We start with share capital as usual. So is there anybody who is able to see the share capital of L? Share capital of L? Yeah, Nigel, that's a very, very good question. I'll be able to tackle that kind of a question, of course, as we move on. But if you never realized any post, you will not have anything to give NCI. And if, for example, you get a loss, you give them their share of losses. Yeah, you give them their share of losses. I shall be able to look at that kind of a question. But for now, fortunately for you guys, your questions are normally direct. So share capital at acquisition. Please ensure that you are participating. I'm telling you, this 500 bob coming your way. So what is the share capital for L? So the share capital for L, ladies and gentlemen, here you can see L is the third company. It is 2,000. And share capital never changes. Share capital will remain the same. So we have here 2,000 bob. 2,000 bob. I'm looking at the equity section. Do we have share premium? This one you can see we don't have any share premium. So then, ladies and gentlemen, I have retained earnings here. Retained earnings, I can see I have 2090. Retained earnings, I have 2090. Retained earnings. At reporting, I have 2090. But you see, this examiner was a tricky examiner. He never gave us retained earnings at acquisition. He never gave us. He wanted us to compute this. And this is what I want you to compute for my 500 bob. He never gave us. For S, he told us retained earnings at acquisition were this much. For S. But for L, he never told us. In this case here for L, the retained earnings he never told us. You can see here, nowhere. He never told us about retained earnings at acquisition. He never told us. But fortunately, we know that L made this profit. There is a profit we know. You can see profit for the year is 860 for L Limited. So using that 860, is there somebody who can give us retained earnings at acquisition, knowing very well that we stayed with L for 6 months? I give you 500 Rosafi. I give you 500 Rosafi. Is there anybody who is able to tell us, ladies and gentlemen, the retained earnings at acquisition? Yeah, you write your answer there, and then you put your mobile number there. I always like blessing my students, especially students who show great interest in group consolidation and a great interest in cash flow statements. Because now on Saturday, I'll be doing cash flow statements. All right. Just one lesson. I'm able to do the direct cash flow and the indirect cash flow. I'll need maximum of 2 lessons, and then I'll be done. I will be done with my part of financial reporting. Perhaps if CPA Kenyani tells me to assist him in some other topics, then I'll be saying bye-bye. But now remember, I'm lucky because my part normally is tested heavily. I'm so sure once I've cleared my part, you guys, especially if you've been very consistent in my classes, you should be able to pass very, very well. So I'm waiting in this case here to see whether there is anybody who will be able to get the retained earnings at acquisition. Elizabeth, same amount, good trial. Emmanuel Ikapel, 1660. 1660. 1660. Emmanuel Ikapel, are you able to give me your number there? Emmanuel, you've gotten that thing. You've nailed it, man. You've nailed it, man. 1660 is the correct answer. Please give me your mobile number there, Emmanuel. You've nailed it. You've nailed it. Actually, I'll add something for you on top. I mean, that's brilliant. That's good. So in the interest of time, Emmanuel, are you able to inbox your number very fast? Not inbox, but just write your number there very fast. In the interest of time, Emmanuel. Emmanuel, in the interest of time. All right. I told you today you're going to get so many presents today. But again, for fairness, once you get a present, in my class, you can't get another present. You only get a present once, so you can spread the presents here to all of us. Everybody needs something, right? Everybody needs something here. But that doesn't mean that you don't continue being active. So I'll give you some 600 bulb, which is very good. I always like blessing my students because I know ultimately it's an investment I'm making. I always get all that money back. Many times I've gotten students bringing me very good gifts. Someone tells me that, Mwalimu, some 20 years ago, you gave me this amount. I mean, yeah. And you never knew. I mean, that time I was very broke. You saved a situation. You saved a situation. Yeah. So they give me good things later on. But the very best thing is that you get to pass your exam. If you get to pass your exam, and then the other thing you're supposed to know, whichever subject that I teach you, and then you happen to get an award. You know, like the papers I teach, like Advanced FM, Advanced FR, I always get awards every semester, every other semester. So like now this financial reporting that I'm teaching now this time around, if you get an award like #1 in Kenya, I adopt you as my academic son or daughter. Academic son or daughter. And once I adopt you, what does it mean? You will never pay fees at RCM, and we shall be paying your custom fees and any other fee, including books, So if you get #1, once you just get that particular notification from CASNEB that you're #1, then automatically we shall be able to take care of you as a school. So you must always have that in mind. You must always have that in mind. So this ninja, how has he gotten this 1660? This ninja has known. So we are here, 31st October 2022. Our retained earnings is 2019. And then profit for the year is 860. So remember the financial year began 1st of October, 1st of November 2021, all right? And then we did this acquisition here. We did this acquisition at the middle here. This L, we bought this L at the middle. We bought L at the middle. We bought L at the middle. We bought L at the middle. 6 months, if you remember. 6 months, if you remember. Here. M Limited is the main competitor of H Limited. And on 1st May 2022, M Limited and H Limited acquired like that. So we acquired this on 1st May 2022. 1st May 2022 here. 1st May 2022. And you counted, you told me May, June, July, August, September, and the whole of October. You told me from here to here, we have 6 months. That's what you told me. So then profits for 6 months. So from here to here, profit will be 430. The profit will be 430. Because you see, it is 6/12 times 860. 6/12 times 860, that will give me 430. So then I want retained earnings as at this date. I want retained earnings at acquisition here. Let this be X. Let this be X. Remember, all the profit we make, we are going to retain. We are not paying dividends. We are not paying dividends at all. That's what the question has told us. So it means that this retained earnings at acquisition, which is X, plus all the profits here, which is 430, should be equal to retained earnings at the end. Remember, these are retained earnings at end. Retained earnings at end. So this should be equal to 2090. So can you kindly then make X the subject of the formula? Please make X the subject of the formula. Please make X the subject of the formula. So retained earnings at acquisition that are X here, plus the profit generated. So this 430 profit was put into the retained earnings basket, the whole of it. Retained earnings basket, the whole of it. So X plus 430 equals 2090. Then what is the value of X? What is the value of X? Is there somebody who is able to give us the value of X here? Is there somebody who is able to give us the value of X? Value of X. So in this case here, our X, if you make X the subject, so X will be 2090. This has to cross over and it becomes negative. Therefore, X will be 16 what here? X will be 1660. X will be 1660. So is that now understandable? Is that clear? This is quite a tricky area, but once you get used to the questions, then you'll be able to just nail this down. So retain the earnings like that. And then now for L, ladies and gentlemen, where is the 860 coming? Thank you very much, Eric, for asking. The 860 is the profit. The 860 is the profit which was generated by company L. This one here, 860, profit for the year, the whole year, this 860. The whole year, 12 months, they generated 860. 860. But you see, I want profit for 6 months because I'm looking at what we call post-acquisition here. From here to here, it will be 430. Erika, have you been able to see where I got that 860 from now? I can see Simon doing like this. Thank you very much. Thank you very much. So please, this is a rehearsable area. You must rehearse here. Now, fortunately, I don't have any fair value adjustment for L. No fair value adjustment for L. They have told us in the question. All right, Emmanuel, great. All right. Now, ladies and gentlemen, so we are told here for you to look at this. Look at this. Look at this. We are told here for L, the fair value of L Limited's net assets approximated their carrying values at the acquisition date. So there was no any revaluation surplus or revaluation losses, no fair value adjustment, and therefore no depreciation on the fair value adjustment. And also the other thing, even if you read anywhere on the entire board, the entire question, there is nowhere that telling us that L did business with H, nowhere. So no UPS upstream. So please come and give me the net assets, total net assets, total. So what are the net assets at acquisition? So this is very easy. This is 3660, and then this is 4090. So what is the post-acquisition profit? It will be 4090 minus 3660. You give me an answer. So 4090 minus 3660, you give me an answer. PAP stands for post-acquisition profit. PAP stands for post-acquisition profit. So 4090 minus 3660, this gives me what figure? This gives me what figure? So somebody tells me it is 430. So this 430 like that. Give us the NCI's share of PAP. Some 300 bob. Some 300 bob. In this case, I will go to that first student who will be able to give me the NCI's share of PAP. Take some percentage, you multiply with that 430, you get your 300 bob, very easy. You get your 300 bob, very easy. So Hope is telling me 215. Hope is telling me 215, 215, 215, 215. I want to see whether, please second her. You can easily get your gift as well. There is a gift hamper for everybody. Naitale, I'm so happy because you guys have known that when it comes to shareholding, when it comes to dividends, it can't be on the management 60% control. No, it is based on your shareholding. And we know that the parent has 50%, NCI, the non-controlling interest also has 50%. So this times 430, which will end up giving us 215. So Hope, I owe you your 300 bob. You need to give me your number there. Ladies and gentlemen, please listen. Once you have reached here, don't continue with any other working. Don't continue with any other working. This is what now you're supposed to do. Start consolidating. So now we start consolidating. So we start with number one. The first part of this question, they want us to give them the consolidated income statement. Income statements, income statement. The name of the company is H Group. H Group. So it is consolidated income statement for the year ending, for year ending, you must write like that, for the year ending 31st October 2022. Underline. We start with number one, consolidated income statement for the year ending 31st October 2022. For the year ending 31st October 2022. So we have here so all right. So we start consolidating, my friends. So how do we get to consolidate? It's very easy to consolidate, really. Very, very easy to consolidate, ladies and gentlemen. To consolidate is to add, isn't it? To consolidate is to add. So hope I've sent you. So I've still two more gifts for those students who are going to give me great answers here. Two more gifts. So we are consolidating. Remember, we have three companies. Two of them are subsidiaries. So we start by consolidating the revenue. So consolidated revenue, I will take the one of the parent wholly. So parent, you shall take wholly. So revenue will be 8460, 8460, 8460, 8460 plus S Limited is 3880, 3880. This for S Limited, I will not time a portion, because we stayed with it for 3 years, remember, 3 years. But S, I must time a portion. S, I must time a portion, not S, but L. Do you remember that we stayed with L for 6 months only? Is there somebody who is able to remember that we stayed with L for 6 months only? Anybody who is able to remember that we stayed with L for 6 months? You guys are not giving me my fast. Great. We stayed with this for 6 months. Now, remember, when you're consolidating revenue, there is an adjustment that we must always make. Is there somebody who is able to remember the adjustment before I start adding there? Is there somebody who is able to remember the adjustment? There is the concept of fake sales. Fake sales. And I gave you an example. When within the family, you sell goods to each other within the family. Like if, for example, my son was to join today RCM, even if he's working, I'm so sure I can't charge him any fees to study at RCM. And if I charge him that fee, for sure, we'll have to subtract that fee when we're looking at our revenues, because that is just money that has come from this pocket to this other pocket. It's money within family. So in this particular year, we had some internal sales. Is there somebody who is able to remember the figure of internal sales? Is there anybody who is able to remember the figure of internal sales? It was only one internal sales figure from note number 4. Is there anybody who is able to remember that figure of internal sales? 400. So this one you subtract 400. So remember this one here, we have to put this in brackets like that, so that you don't subject this 6/12 with what here with these other numbers. Remember, this is for the parent plus subsidiary 1 plus subsidiary 2. Subsidiary 1, remember, is a S, which we stayed with for 3 years. So in the current year, it was fully our subsidiary. So we shall not time apportion this year's revenue. And we can't multiply with 3. Remember, income statement is for 1 year, right? Income statement is for 1 year. But remember, this subsidiary 2 is a L. L in this case here, we stayed with it for 6 months. So this has to be time apportioned. And then if there is any internal sale, this internal sale is fake. It's fake. So you come and subtract it, and then you give me an answer. So you take your calculator out. So we have here 8,400 plus 3,880 plus 3,200 times 6 divided by 12 minus 400. What are they getting here? There is no much adjustment in terms of revenue. No much adjustment in terms of revenue. I'm getting 13,480. Simon, how did you subtract? Myself, I'm getting 13 unless I took something wrong. Or they're getting 13,540. Then I must be wrong. Where did I go wrong? Let me just come and redo this. Oh, this is 3460, right? Not 34. I took 8400. Let me just check. Let me just check. Let me just check. The first one. The first one is 8460, not 8400. This first one here. This first one is 8460, not 84. So I need to come back here, just back like that. Back like that. Please, everybody should be able to do this working. Everybody should be able to do this working. So we have just back a little bit. Yeah, we're getting 13,540. So this is in shillings millions, and we're getting here 13,540. Thank you very much. So we go to consolidated cost of sales. Many students are not able to get this consolidated cost of sales. So what do we do for consolidated? First of all, we appreciate that we are just adding. So consolidated cost of sales, ladies and gentlemen, this is what we have here. And the consolidated cost of sales, we have here 4040 for the parent, 4040 for the parent, plus, ladies and gentlemen, we have the subsidiary, first subsidiary S, 2910, the whole of it, plus L subsidiary, I will take in this case here 1020, 1020. This has to be time apportioned, times 6/12. And then now the first thing that I do, ladies and gentlemen, when I'm doing my consolidated cost of sales, I must come and subtract, just like I subtracted here. I must come and subtract what there. I must come and subtract any internal sale. Any internal sale must be subtracted. Remember, in cost of sales, how do we get cost of sales? Opening stock plus purchases minus closing stock. So we have purchases. One of the companies saying, I sold goods to H at 400. And then on the other side, H is saying, I purchased goods. So where do we find this 400? In two areas. In the sales, so go to the sales, subtract the 400, fake sales. Go to cost of sales, subtract the 400, fake purchases. And then, ladies and gentlemen, there is another adjustment that we must always remember in the cost of sales. Can somebody give me this other adjustment that we must always remember? There is something that we must always bring in the cost of sales whenever we are consolidating. There is something we must always bring here whenever we are consolidating. Remember this, you have a gift, even if it will be just 400 shillings. You remember this, you have a gift. There is something that we must bring here. Yeah, I like what Samuel is telling me there. Yeah, that's one of them. That's one of them. That's one of them. Then there is something. Yeah, Hope is getting it. Hope has gotten this. The unrealized, the URP, the unrealized profit on stock. So remember, whenever you get UPS, you shall always add UPS to cost of sales and subtract it from group inventory, So shall always add it. You shall always add UPS to cost of sales. So come to cost of sales here and add the 20 like that, and add the 20 like that, add the 20 like that, add that 20 like that. You add the 20 like that. And I can explain why we are adding 20 to cost of sales. I can explain. Because how do we normally get cost of sales? We normally take opening stock. We say plus purchases. And then we say less closing. So if, for example, I have this opening stock as 10, purchases as 20, and then closing, for example, as 12. So in this case here, could you kindly give me this cost of sales? Please give me this cost of sales. Can somebody give me this cost of sales? So what is 10 plus 20? That is 30. 30 minus 12, that gives me 18. And then somebody comes and tells me, no, your closing stock is overstated. Your closing stock is overstated by 2. So then I come and do an adjusted working. So this will be 10, 20, and this will be 10. Because the closing, I'm being told, it's overstated. by 2. So can somebody then give me, in this case here, the new cost of sales? Can somebody give me the new cost of sales? It will be 10 plus 20, that's 30 minus 10. This gives me 20 like that. This gives me 20 like that. Now, ladies and gentlemen, please listen and listen and listen to me very well. You can see when we overstated our closing stock, our cost of sales is understated. All right. All right. So then what I should have done, I should have simply come here and taken the cost of sales, which was 18, plus assuming this difference is the UPS. I should have just added the UPS of 2 to get what here? To get 20, like that. Please, I don't want to go into this really semantics here. The most important thing, if I were you, would be to write this UPS. That whenever you get UPS, you shall always add UPS to cost of sales, and you shall subtract it from group inventory. Now listen, Simon. It's Simon who told me, Mwalimu, bring depreciation. I must know, what depreciation are we bringing here? What depreciation are we bringing here? We can only take to cost of sales according to IAS 16. We can only take depreciation of PPE. Depreciation of PPE to cost of sales, property, plant, and equipment. But if it is depreciation of goodwill, you see that when we call it impairment, intangible assets, intangible assets. Intangible assets, we call their loss of value impairment. That can only go to administration expenses. Administration expenses. Remember IAS 16. That it's only depreciation of tangible, those assets that you can touch, which can only go to your cost of sales. And even these tangible assets, for example, like I've seen this severally, you are told that the asset that was fair valued is a distribution van. You see, distribution is beyond production. It's beyond production. So its loss in value can only be charged under distribution expenses. Cost of sales depreciation will only be for production equipment. Our, for example, production factories, production machines, anything that is holding us, or rather in this case here, enabling us to produce this good and put it to a point of sale. So it is property, plant, and equipment only. Property, plant, and equipment depreciation that shall be charged to cost of sales. For us here, the depreciation that we have, the extra depreciation, is depreciation of a brand asset. Brand asset like RCM Online, college brand, it's a big brand, but you can't touch it. So that's impairment. That can only go to administration. That can only go to administration. So then we are over with this. Get your calculator. So we have 4040 plus 2910 plus 1020 times 6 over 12. Times 6 over 12 minus 400. In this case here, plus 20. I like punching this because I also learn in the process. So then we have here 70, 80. Subtract this, and then you'll be able to give us what we call gross profit. You'll be able to give us what we call gross profit. So gross profit will be that 70, 80 minus this 13 of 540. What figure do we have there? Somebody 64 what here? Is there somebody who has 64? 64, 60 there. Is there anybody who has gross profit of 64? 60. 64, 60. 64, 60. Is there anybody who has gross profit of 64? 60. 64, 60. Thank you so much. Thank you so much. 6460. Now from there, you simply follow whatever is in the question. You are following whatever is in the question. So now we have the gross profit. From there, we have distribution cost. This one is very easy. Very easy. No adjustment, basic. Not unless I had a distribution van. Distribution costs. So distribution cost, what do we have here? I have a figure of 725 plus 200. So we have 725 plus 200 plus 725 plus 200 plus 220. 220 plus 220 plus 220 times 6 over 12. No adjustment. Can somebody give me this free mark thing? So we have 725 plus 200 plus 220 times 6 divided by 12. What are we getting, ladies and gentlemen, there? What are we getting, ladies and gentlemen, here? What are we getting, ladies and gentlemen, here for distribution cost? Please help me. We're almost finishing. Please help me. So Simon is giving me a figure of 1035. So from there, we have administration costs. Administration costs. So administration cost, you have to be very careful. If we have any impairment in goodwill, to come here. Any impairment in terms of brand names, intangible assets will come here. So we have, ladies and gentlemen, administration costs. So the admin cost that we happen to be having, the admin cost that we happen to be having here, it's 11. Check this. Admin cost that we have, we're almost finishing. Admin cost that we have here, ladies and gentlemen, we have 1150 plus 350 plus 340. So 1150 plus 350 plus 340 plus 340. Yeah, times 6 over 12. So is there anybody who is able to remember that we had some impairment of brand name? And if you're able to remember, how much do we bring and add here? You give me this correct answer, I give you airtime. I give you airtime. How much do I come and add there? You give me this correct answer, I give you airtime. You give me this correct answer, I give you airtime. How much should I come and add here? 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 Yeah, if you'll be the first one to give me the correct answer, I give you airtime right away. I give you airtime right away. I give you airtime. Elizabeth, you are almost there. But now remember, 60 is for 3 years. And the income statement is per year. This is an income statement for just 1 year ending like that. So Elizabeth, in this case here, we should have worked with 20. We should have worked with 20. So is there any ninja who was able to give me this 20? Because it would be impairment for just 1 year. For just 1 year. Is there any ninja who was able to get us this 20 there? We give him airtime. LC, I hope you have been able to see it can't be 60 because 60 is for 3 years. It can't be 60. 60 is for 3 years. So we have 1150 plus 350 plus 340 times 6 over 12 plus 20, which gives me 16 what here? 1690. 1690, which gives me 1690. So please remember, administrative costs. Don't forget those impairments of intangible assets. Don't forget those impairments of intangible assets. Impairments of intangible. I can see a ninja who got this right. Eric Mbogwa. Yeah, Eric Mbogwa, please send me your number very fast. We should not waste time. Send me your number very fast. Send me your number very fast. Ladies and gentlemen, after that, I can see they need me to give them profit from operations. So come and mention their profit from operations. So profit from operations. So profit from operations, what do I have? I will take this 6460 minus 1035. So 6460, 6460, 6460 minus 1035 minus 1035 minus 1690, which will end up giving me 3735. 3735. 3735. That's profit from operations. And then you can see we have an investment income of 600. Let's recognize it. Investment income. Investment income. You can see it is 600 plus 0 from subsidiary 1 plus 0 from subsidiary 2. Nothing here times 6 over 12. So this, of course, will end up giving me 600. It's an investment income. That will end up giving me 600. That will end up giving me 600. Yeah. So up to here, ladies and gentlemen, somehow, are we together up to here somehow? Are we together, my good students? Are we together here, my good students, up to here? Are we together, my good students, up to here? Are we together, my good students, up to here? Are we together, my good students, up to here? Are we together, my good students, up to here? Great, great, great. So what do we have, ladies and gentlemen, here? So Eric, this was just airtime, and I really appreciate your work. I can see you are really very aggressive, which is very, very good. Very aggressive, which is very, very good. Thank you very much. Yeah. How did I get the 20 for impairment? Remember, we had a fair value adjustment of brand name. Must have come in late, Ninja. Brand name, which was 100. And then we said depreciation. Brand, of course, we call loss in value impairment. Because brand is something you can't touch, it's an intangible asset. So it was 100 divided by 5 years. It had a remaining useful life of 5 years, which gave us 20. And for more information, you'll be able to watch that video. But again, most importantly, it's for you to be able to see here that we have this brand. It had 5 years. That the excess of the fair value over the carrying values was due to unrecognized brand whose remaining economic useful life at the date of acquisition was 5 years, like that. So, ladies and gentlemen, after this profit investment income, of course, I can see the next thing here is the finance cost. Recognize it. Your work is to recognize things. So we have here finance cost. So finance cost we have 450. So finance cost we have 450. Finance cost we have 450. So finance cost we have 450 plus. Normally finance cost, I mean, there is no adjustment. Free marks, low hanging fruit. 175 plus 320. The 320 is for a whole year, but this thing was only hours for 6 months. So times 6/12. So can somebody in this case here give us this answer? Can somebody in this case here give us this answer? Can somebody give us this answer? Mohammed, I hope you saw I got that 20, but it's like you came today a bit late, but you'll be able to watch the video, Mohammed. I've trust in you. 785. So 785, like these are deductible. So of course, the other one is an addition. They give us profit before tax. Give us profit before tax. So give us profit before tax. So profit before tax, please subtract very fast. Time is not on our side and I have another class. Time is not on our side and I have another class, 3550, yeah? Thank you very much, Mohammed. So this is 3550. How did they get this? They took 35 plus 600 minus 785, giving me 3550. So go ahead and pay taxes. You must pay taxes. The only things that are constant in this life is death and payment of taxes. You must pay taxes. Go ahead and pay your tax for the group. So tax, I can see 680 plus 80 plus 80 plus 680 plus 80 plus 680 plus 80 plus 440. But remember, this 440 has to be time apportioned. 6/12, no adjustment. Free marks, remember. This will be a free mark. So 680 plus 80 plus 440 times 6 divided by 12, which will end up giving me 900. What year? 980. Once you pay your taxes, then you have profit for the year. Profit for the year. So profit for the year, remember, this is our profit after tax. 2570. I'm being given 2570. And then there is a free mark that students normally lose for nothing. What we call other comprehensive incomes. Free mark. Other comprehensive incomes, we abbreviate this as OCI. Other comprehensive incomes, we abbreviate this as OCI. So this OCI normally is for revaluation gains. Remember, revaluation gains cannot be part of our P&L. If you take revaluation gains as part of your P&L, the shareholders would want dividends. So normally we take this one here as other comprehensive incomes. When you come to the advanced level, we shall be able to explain. For you, you're following the pro forma given. So the pro forma given, ladies and gentlemen, here that we are following, here We are given here other comprehensive incomes, gain on property revaluation, 70. So we have a gain, what we call revaluation gain, revaluation gain, revaluation gain. So revaluation gain, we have here 70 plus 0 plus 0 times 6/12, which will still end up giving us 70. So now we have here the total comprehensive incomes. Total comprehensive incomes, which basically is our P&L plus the OCI. P&L plus the OCI. So the total comprehensive incomes, you take that 2570 plus 70, which will end up giving us what figure? Which will end up giving us what figure? Which will end up giving us what figure? 2640. So once you reach here, ladies and gentlemen, you should be able to go straight away and do the consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position, like that 2640. That is very, very good. That's very, very good. The question paper, already LC, it is in your class group. It is in your class group, LC. You haven't seen it yet. LC, it is in your class group. If you go to the FR evening, FR 6 p.m., you'll be able to get it there. If you don't have it, and maybe if you are not in our group, you can always reach out to me on WhatsApp, and then I'll be able to send it to you. This is my personal number. This is my personal number, 0721-620-183. That's my personal number. So then I have a request to make. I have a request to make for some great amount of money. All right. I would want you to take like 20 minutes, and do for us the consolidated statement of financial position, exactly 20 minutes. We see how far you'll be able to get with this consolidated statement of financial position, and then we give you something what here, something very good, something very good. Now, one thing that I would want us to talk about, of course, the students who are following me on YouTube, I believe you'll be able to do what you do, like my post, give me thumbs up, give me loves there. And then most importantly, ensure that you are doing what you're subscribed, and ensure that you are subscribing to my channel, which really is a